Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
All right, let's kick this off by painting a picture for you. What if your mobile game wasn't just a game on a screen, but a gateway? An immersive portal blending AI-driven worlds, virtual reality adventures, vibrant metaverse communities, all of it vying for your attention in ways we're only just starting to grasp.
It's a huge shift.
This explosion of new digital engagement frontiers is undeniable, and it's fundamentally reshaping how we interact with content.
Absolutely.
But in this landscape of rapid digital transformation, what happens to the multi-billion-dollar engine of mobile game advertising that has powered companies like AppLovin to prominence?
That's the core question, isn't it?
Can a company built on that traditional foundation not only survive, but truly thrive in this evolving environment? Or does this rapid shift to AI, VR, and beyond spell trouble for its core business?
Yeah.
We're going to explore this pivotal question today, and by the end of our conversation, we'll uncover the answer.
It's a critical question for individual investors because we're witnessing a profound transformation in how users engage with digital experiences. Understanding how a company rooted in mobile advertising can navigate and capitalize on dynamic new paradigms like the metaverse is absolutely essential.
Definitely.
We'll delve into the strategic moves, the technological advantages, and the visionary leadership that are all at play here, helping you understand their true potential.
That's right. To really understand their future, we first need to dissect what makes their current engine tick. How exactly does this company operate at its core, and how has that core evolved to meet these new digital demands?
Let's get into it.
At its heart, the business functions much like a hyper-efficient, real-time auction house for mobile ads.
Like an eBay for ad space, almost.
You can literally think of it as the eBay of mobile ad space, exactly. But instead of bidding on rare collectibles, thousands of advertisers are simultaneously bidding on tiny slivers of screen time on your phone.
Happening in milliseconds.
What makes this company truly stand out, though, isn't just the auction mechanism itself. The real magic, the secret sauce, is how its proprietary AI, known as AXON, intelligently matches that available ad space to the exact right user.
In mere milliseconds, yeah.
It's almost like a super smart streaming service, but instead of recommending your next favorite show, it's recommending a game or an app that's perfectly tailored to your interests and past behavior.
So better targeting.
This isn't just about throwing generic ads at a wall and hoping something sticks. It's about surgical precision, ensuring that the ad you see enhances your experience, making it feel less like an interruption.
And more like a helpful suggestion. Hopefully.
Yeah, exactly. And for app developers, this is gold because it means their ad spend is incredibly efficient, reaching users who are genuinely likely to engage.
Precisely. Their fundamental role is empowering app developers, particularly those in the incredibly competitive mobile gaming space, to both effectively monetize the amazing creations they build through advertising and acquire new, high-value users.
It's a two-sided coin then, monetization and user acquisition.
Absolutely. The company generates its revenue by taking a percentage, of these countless daily transactions.
Okay.
What's truly sophisticated beneath the surface is the sheer power of those proprietary AI algorithms within their AXON platform.
Right, the AXON tech.
These algorithms analyze billions of data points daily, everything from your app usage patterns to your gaming preferences, to predict user behavior with remarkable accuracy.
Billions is a lot of data.
It's immense. This level of precision is about optimizing for engagement. It's about ensuring smarter, more relevant ads that actively keep players hooked and coming back for more, ultimately boosting the developer's bottom line.
So it helps the developers make more money.
It's this deep, data-driven insight that sets them apart from the competition.
That level of technological sophistication sounds like a superpower, but how big of a leap is it really to go from a model built for traditional, often interruptive mobile ads to something as seamless as VR product placements?
That's a great question.
Are we talking about a simple upgrade or a fundamental re-engineering of their core tech?
What's fascinating here is that while it sounds like a massive jump, their AI is already proving its adaptability.
How so?
Think about how AXON successfully optimized ads during a recent viral augmented reality or AR game surge.
Ah, okay.
Publishers saw their revenues boost by an impressive 30% because the AI could adapt dynamically to that new, interactive, real-world blending environment.
30% is significant.
It really is. The real insight here isn't just the number. It demonstrates their AI's agility and scalability in a rapidly changing digital landscape,
Which is key right now.
suggesting a core competency that differentiates them from slower-moving rivals who might struggle to make such rapid shifts.
Absolutely, that agility is key. And moving from the underlying model, let's look at their powerhouse product portfolio, which truly evidences strong market fit and strategic foresight.
Yeah, the actual tools they offer.
This isn't just theory, it's tangible, evidenced by a remarkable 71% advertising revenue growth in the first quarter of 2025. 71%, wow.
Their flagship offerings include app discovery.
Crucial for getting new users, as we said.
Right. Then there's Max, their sophisticated in-app ad auction platform that optimizes ad delivery, Adjust, which provides vital analytics and measurement tools for campaigns,
Can't improve what you don't measure.
and Whirl, a strategic expansion into the rapidly growing connected TV, or CTV, advertising market.
Moving beyond just mobile.
All these products fundamentally leverage AI to adapt to emerging ad formats, including even AI-generated content within games themselves.
That's the really futuristic part. Imagine an AI dynamically creating a billboard for a real-world product right inside the virtual world you're exploring.
Or like generating a custom virtual outfit in-game that links directly to a brand.
Exactly. This blurs the lines between game and advertisement in a way that feels native rather than intrusive.
And looking forward, they have a clear, ambitious product roadmap that indicates they're not resting on their laurels.
They can't afford to. A key part of this is AXON 3.0, which is slated for release in late 2025. This isn't just an incremental update. It aims to integrate Metaverse and VR data directly for advertising within virtual environments.
So taking data from VR experiences to inform ads.
We're talking about ads that truly live inside the digital worlds you inhabit, responding to your movements and interactions.
That's a whole new level of integration.
They've already shown concrete innovation, like the early 2025 launch of generative AI tools for ad creatives.
Right. Tools that make the ads themselves.
These tools can automatically produce a vast array of ad variations, testing and optimizing them at scale. This directly impacted advertiser return on investment, or ROI, by 25% in mobile games.
25% higher ROI is huge for advertisers.
By effectively countering the user fatigue that often comes with traditional static advertising. It's about making ads a seamless, even enjoyable part of the experience, not a disruption.
What's equally compelling is the company's established track record of strategic reinvention. This isn't a one-trick pony relying on past glories.
They've definitely evolved.
From its founding in 2012 as primarily a mobile game developer, it made a pivotal and bold shift into ad tech after a series of strategic acquisitions post-2018, culminating in its successful public offering in 2021.
That pivot was key.
Key milestones highlight this incredible adaptability. The launch of AXON 1.0 in 2022, for instance, led to astonishing 50% revenue jumps, demonstrating the immediate power of their AI.
50% just from AXON 1.0.
And significantly, in 2025, they completed the strategic divestiture of their gaming studios for a substantial $800 million.
That was a big move, selling the game side.
This was a bold and calculated move, designed to sharpen their focus entirely on advertising technology amidst the undeniable rise of Metaverse platforms and new digital engagement paradigms.
Doubling down on ad tech.
This demonstrates their willingness to shed non-core assets to focus on where the puck is going.
This divestiture isn't just a financial transaction, it's a powerful statement about their resilience and forward-thinking adaptability.
Absolutely. A statement of intent.
We've seen them expand into connected TV during privacy crackdowns on traditional mobile advertising, demonstrating their ability to find new, lucrative avenues for growth when established ones face challenges.
They don't just sit still when things change.
Their rapid pivot of research and development towards generative AI tools, for example, didn't just happen by accident. It resulted in a tangible 20% gain in advertiser spend because their tools offered real value.
20% more spend flowing their way.
This isn't about incremental adjustments. It's about agile, significant strategic shifts. And the numbers truly back this up. Their first quarter 2025 revenue increased a robust 40% year over year to $1.5 billion.
$1.5 billion in a quarter.
And their mobile ad market share has steadily risen to 15%. They're consistently growing and gaining significant ground in an incredibly competitive and dynamic space, proving their ability to capture market share even as the digital landscape transforms.
Okay, so shifting our focus now to the driving force behind this company's strategic maneuvers, its leadership and vision.
Right, the people making the decisions.
At the helm is Adam Foroughi, the co-founder and CEO. His extensive background as a serial entrepreneur in mobile technology has been absolutely instrumental in guiding the company toward AI-enhanced advertising innovation and anticipating industry shifts.
He's been there from the start.
Foroughi has personally led crucial decisions, such as the ambitious rollout of AXON 2.0, which truly supercharged ad targeting and optimization.
Pushing the tech forward.
He also spearheaded the strategic push into CTV advertising via the Whirl acquisition, effectively capturing those ad dollars that are shifting away from traditional mobile banners to more immersive and connected formats, acknowledging the fragmentation of user attention.
His expertise in data-driven marketing and foresight into technological trends has profoundly shaped their strategies to adapt to this fragmented user attention, positioning them perfectly to capture ad dollars shifting to these new immersive formats.
He seems to see where things are heading.
And complementing Foroughi's visionary leadership, we have Matthew Stump, the CFO. His deep finance background, honed at previous leadership roles in major tech firms, has ensured disciplined capital allocation and robust financial stewardship.
You got to have strong financial oversight.
Stump notably oversaw that bold mid-2025 divestiture of the company's gaming studios, a move that strategically freed up a substantial amount of capital specifically for critical AI investment.
Yeah, turning those assets into cash for R&D.
This decision directly addresses how the company plans to adapt to these new engagement paradigms, like the emergence of Metaverse platforms drawing users away from standalone mobile games and into richer virtual worlds.
Adding further depth and strategic expertise to their leadership team, Maynard Webb was appointed to the board in early 2025.
Webb has serious Silicon Valley cred.
With his extensive Silicon Valley experience, including founding Web Investment Network and chairing Yahoo, he brings crucial insights into effective corporate governance and, importantly, the ethical development and use of AI in advertising.
That ethical piece is becoming huge, especially with AI.
This is particularly vital as privacy concerns continue to rise, with deeper user behavior tracking, enabled by advanced AI and potential VR integrations, ensuring the company maintains trust as it innovates.
It's important for you to know that this company remains founder-led, with Adam Foroughi deeply involved in daily decision-making, from product roadmaps to those bold strategic pivots, like divesting the apps business to triple down on advertising technology.
That hands-on approach matters.
This isn't a family operation, but it truly embodies the outperforming traits often seen in founder-driven companies, where a long-term vision aligns directly with a culture of relentless innovation.
Founder-led companies often outperform, statistically.
Foroughi has proven himself an exceptional leader, blending business acumen with technological genius. His compensation isn't just tied to short-term profits, it's heavily weighted towards stock performance and revenue milestones, with equity grants specifically vesting on AI adoption targets.
So his incentives are aligned with long-term AI-driven growth.
This structure ensures a relentless focus on adapting to digital shifts like Metaverse advertising, directly motivating leadership to scale products amid evolving user engagement patterns.
The company's mission is clear and compelling: to empower businesses to connect meaningfully with customers through innovative technology.
A pretty standard tech mission, but seems genuine here.
This mission drives an ambitious goal: dominating the future of digital advertising in a world increasingly defined by pervasive AI, immersive VR, and interconnected metaverse interactions.
They're aiming high.
Their leadership articulates a clear vision of seamless, data-fueled ad experiences across diverse platforms. Foroughi himself has spoken publicly about AXON evolving to handle immersive ads within virtual worlds, not just simple banners.
Setting expectations for the future.
The company culture itself powerfully reinforces this vision. It emphasizes extreme agility and a deep obsession with data, fostering a workforce adept at rapid iteration.
You need that agility in this space.
This is vividly evident in how they've rapidly enhanced Max for VR game integrations, which is absolutely crucial for staying ahead in a landscape where user engagement is fragmenting across these new, rich digital realities.
Now let's talk about the bedrock of this company's strength. Its unbreakable advantages, what we often call its enduring moat.
Right. What protects them from competitors?
In the rapidly evolving arena of mobile game advertising, where immersive platforms are reshaping user engagement, think seamless virtual worlds where ads blend into gameplay rather than interrupting it, this company truly exhibits near monopolistic traits.
Not a true monopoly, but close in their niche.
It's not a full government-regulated monopoly like a utility, but with an estimated 15–20% market share in global mobile ad mediation as of mid-2025, its formidable control over in-app bidding ecosystems creates incredibly high barriers to entry for any new competitor.
15 to 20% is a solid chunk of the market.
The real insight here is that their established footprint and technological superiority make it incredibly difficult for rivals to even begin to compete at scale.
This dominance stems from an absolutely vast and ever-growing data trove. They process over 1 billion daily ad impressions.
1 billion.
Daily, which translates into trillions of data points annually, allowing for a level of hyper-precise targeting that smaller players simply cannot replicate or afford.
That data is the real asset.
For instance, during the 2021-2022 privacy upheavals triggered by Apple's IDFA changes, that's the identifier for advertisers, a unique code on Apple devices that allowed advertisers to track user behavior across apps. The company pivoted swiftly.
Ah, yes. The IDFA impact was huge for many ad companies.
They leveraged their proprietary data and advanced contextual AI to maintain ad efficacy, while many competitors saw their revenues dip by a painful 10–15%.
So they navigated that challenge better than others.
This regulatory adaptability, navigating complex privacy laws with compliant AI models, directly protects their profitability. In the first quarter of 2025, their gross margins hit an impressive 40%, far above the industry average of 25–30%.
40% gross margin is very healthy.
In the context of tomorrow's world, where Metaverse ads will demand real-time VR integrations and incredibly granular data, this scale acts as a powerful moat, deterring new entrants who lack the necessary data infrastructure to compete effectively in these immersive environments.
Scale becomes even more important then.
Analysts believe this positions them to capture an ambitious 25% of the projected $100 billion immersive ad market by 2030, solidifying that quasi-monopolistic edge.
Beyond market share and data, their economies of scale are shining brightly, especially as mobile game ads must now scale across fragmented digital engagements, from AI-personalized feeds to VR sessions that can last for hours.
Scale equals efficiency.
Operating at a truly massive scale, handling an astounding 200 billion daily ad requests by Q1 2025 gives them inherent cost advantages that completely dwarf smaller competitors.
200 billion requests a day. The infrastructure needed for that is immense.
For example, their cost per ad impression has dropped a significant 25–30% over the past 2 years alone.
Lower cost per ad.
This isn't just due to sheer volume. It's a result of optimized server infrastructure and sophisticated bulk data processing, allowing them to reinvest into cutting-edge AI research and development at a fraction of the cost rivals face.
To put that in perspective, some rivals' ad unit costs remain a substantial 15% higher.
That's a significant cost difference.
A compelling anecdote from early 2024 further illustrates this. As AI hype surged, their AXON 2.0 platform scaled across e-commerce ads without proportional cost hikes, boosting return on investment for advertisers by 35%.
35% ROI boost.
And directly contributing to that impressive 71% ad revenue growth in Q1 2025. This efficiency is absolutely crucial for adaptation.
Right.
As VR and the Metaverse demand high-compute ad rendering, think generating complex virtual billboards in real time or dynamically inserting branded objects into a virtual world, their scale enables low-cost experimentation and deployment.
So they can try new things more cheaply.
They're already piloting VR ad formats that cost 50% less per unit to develop and deploy than what smaller startups are facing.
Half the cost is a huge advantage.
Quantitatively, this operational efficiency translates to their earnings before interest, taxes, depreciation, and amortization, or EBITDA, margins expanding to 47% in Q1 2025, up from 37% year over year.
47% EBITDA margin is stellar.
The true takeaway here isn't just better margins, but that their scale creates a self-reinforcing advantage. Lower costs mean more capital for R&D, which in turn deepens their tech moat, especially vital in the resource-intensive, immersive ad development space.
And then there are potent network effects, which form another crucial bedrock of their enduring moat.
Ah, the network effect. Very powerful in tech.
They create a self-reinforcing cycle that's particularly powerful as mobile game advertising evolves toward interconnected digital realms like metaverses.
Explain how that works here.
The more app developers integrate their Max platform, which by 2025 is integrated into over 1 million apps globally, the richer and more diverse the data pool becomes.
More apps mean more data for AXON.
This, in turn, continuously enhances AXON's AI predictions, making ad targeting even more precise and effective. That improved efficacy then attracts even more advertisers who see better results for their campaigns,
So better results attract more advertisers,
which increases bids and revenue for developers.
which attracts more developers. It's a virtuous cycle.
Exactly. The value simply skyrockets with each new addition to the network. We see this concretely in the data. User acquisition costs dropped an impressive 20% for publishers in 2024 as network growth improved matching accuracy to an astounding 95%.
20% cheaper user acquisition is a major draw for developers.
That's a direct, measurable benefit to their partners.
A real-world case study from the 2023 VR gaming boom highlighted this power. Their network enabled seamless cross-promotion from mobile to VR apps, which increased user retention by 40% for partners like hybrid casual game studios.
40% better retention by linking mobile and VR.
Unlike linear business models, this creates exponential value. One more advertiser boosts bids, benefiting every app developer on the platform by increasing their ad revenue.
It's not just adding 1 + 1 = 2.
Exactly. In tomorrow's landscape, where engagement spans AI-driven worlds and immersive metaverses, these network effects are set to amplify dramatically.
How so?
Imagine AXON pulling data directly from your VR interactions, how you move, what you look at, what you buy in virtual stores to refine mobile ads you see later.
Creating a true cross-reality profile.
Creating a true cross-reality network that would be incredibly difficult for anyone else to replicate. With over 1 billion daily users feeding this data loop, their growth projections aiming for 50% total addressable market, or TAM, capture and immersive ads, clearly demonstrate how network effects ensure scalability amid ongoing digital fragmentation.
They also masterfully employ strategic counter-positioning. They emphasize AI precision over brute force volume, a strategy that truly differentiates them.
Quality over quantity.
In a future where mobile ads must integrate seamlessly into VR and metaverse experiences without alienating users, while competitors might flood markets with generic interruptive ads, this company offers uncopyable generative AI tools via AXON.
The generative AI piece is key.
These tools create hyper-personalized campaigns, dynamically adjusting creative elements and messaging based on user data in real time, something rivals simply can't easily duplicate due to their more siloed data and less advanced AI.
It's hard to copy that level of AI sophistication quickly.
The market response has been overwhelmingly enthusiastic. In the first quarter of 2025, this approach led to a phenomenal 71% ad growth amid overall industry stagnation.
71% growth while others were flat.
That says a lot. With e-commerce advertisers in particular shifting their budgets specifically because they saw a 25% higher return on investment.
It's a compelling strategic narrative. CEO Adam Foroughi's decision in 2023 to double down on AI investments after privacy crackdowns while many peers were cutting R&D truly paid off.
That was a contrarian bet at the time.
AXON successfully adapted to metaverse prototypes, embedding ads as interactive elements. For example, offering virtual product trials directly within games, or dynamic billboards that change based on your virtual location.
Making ads part of the experience, not an interruption.
This focus on non-intrusive formats positions them to thrive. This means ads that aren't pop-ups, but rather things like virtual product placements in a digital store within a game, or dynamic sponsorships on virtual sports arenas that feel like a natural part of the environment.
Much more subtle.
This positioning not only locks out imitators who can't replicate the AI precision, but also scales effectively in these new engagement formats. As AI continues to enable predictive marketing in VR, their focus on seamless integration is a powerful differentiator, which is further evidenced by partnerships with VR developers yielding significant 30% engagement lifts.
High switching costs act as an invisible fortress for the company, effectively locking developers into its ecosystem amidst the shift to multifaceted digital engagements.
It's hard for developers to leave once they're integrated.
Migrating from their Max platform isn't just a technical rework. It could involve months of complex app recoding, retraining development teams, and crucially, a significant risk of lost revenue due to disruption.
It's a major pain to switch ad platforms.
But it also involves emotional and logical hurdles, like forfeiting AXON's deeply optimized data insights and proven ad efficacy. Quantitatively, churn rates hover below a remarkable 5% annually.
Less than 5% churn is incredibly low. Sticky platform.
With developers consistently citing 20–30% revenue drops during attempted transitions to competitors.
An anecdote from 2024 perfectly illustrates this challenge. A mid-tier game studio, in an attempt to cut costs, tried to switch to a competitor's platform.
How did that go?
They returned after just 3 months, having lost an estimated $500,000 in ad yield due to inferior AI targeting and less efficient ad delivery.
$500,000 lost in 3 months. Ouch.
That's not just a technical hurdle, that's a direct hit to the bottom line, underscoring how deeply integrated their platform becomes to a developer's financial success.
It proves the value proposition pretty starkly.
In the future context, as VR and Metaverse ads require even deeper, more complex integrations, like real-time data syncing across different realities and highly specific content delivery, these switching costs will only escalate.
It gets even harder to switch later on.
Developers face the daunting task of rebuilding entire ad pipelines from scratch, making this company's platform truly indispensable for scaling successfully in immersive worlds.
Beyond the technical, their brand as the AI ad innovator fosters deep loyalty, enabling them to command premium pricing in a market where trust, particularly with rising VR privacy concerns, is paramount.
Brand and trust matter, especially with data.
Built on consistent quality, AXON's proven 95% prediction accuracy, it commands 10–15% higher cost per mil or CPMs than its peers.
Charging a premium because they deliver results.
Studios praise the company for future-proofing ads post-divestiture, leading to an impressive 80% retention rate. This positions them perfectly for premium immersive formats, with Q1 2025 data already showing 40% margin expansion from early branded VR pilots.
They also corner unique, hard-to-replicate resources. This includes over 200 AI patents on advanced ad algorithms, creating a formidable intellectual property barrier.
Patents provide legal protection.
They also boast elite talent from top tech companies, with a 20% higher engineer retention rate, partly due to attractive equity ties.
Keeping top AI engineers is critical.
Furthermore, strategic partnerships with major app stores and a vast trove of historical data from over $10 billion in ad spend create an infrastructure that would be incredibly difficult for any competitor to replicate from scratch.
That historical data is another huge asset.
In the future, this talent edge, they specifically hired VR specialists in 2024, enables rapid prototyping and seamless integrations, like AXON-powered virtual ads appearing natively within virtual environments, giving them a crucial first-mover advantage over resource-dragged rivals.
Furthermore, years of refining their real-time bidding processes yield significant operational advantages. They boast 20% cost advantages and superior quality that would be incredibly hard to copy in today's fast-paced digital shifts.
That operational excellence is hard-won.
Their auction optimizations, meticulously iterated since 2018, handle complex challenges like VR latency issues better than competitors. This was clearly seen in 2025 tests, which showed a remarkable 50% reduction in ad load times within VR environments.
Half the loading time in VR is a big deal for user experience.
This significantly enhancing the user experience in immersive games where even a split-second delay can be jarring.
The proprietary technology, AXON, is a true standout. It's truly 10 times better in efficiency, using AI for predictive targeting that adapts seamlessly to both AI-driven content and new VR trends.
10 times is a bold claim, but shows their confidence.
Launched in 2023, AXON processes multimodal data, including emerging VR behaviors, outperforming peers by 30% in engagement, a crucial factor for scaling in metaverses where ads must feel truly native and interactive.
And timing, as they say, is everything. They timed the launch of AXON 2.0 perfectly with the 2023 AI waves, capitalizing on post-privacy needs exactly as metaverse hype was building.
Great timing, catching multiple waves.
This first-mover status in AI-driven advertising gave them a significant lead in early VR trials, allowing them to learn and adapt without the pitfalls that plagued early entrants into the VR space from the early 2010s.
Learning from past VR failures.
Their speed of execution is also remarkable. They launched complex generative AI tools in a matter of months, discouraging competitors from even attempting to follow, and executed rapid connected TV expansions in 2025 amidst ongoing metaverse shifts.
Moving fast is a competitive advantage in itself.
Stories of overnight AXON updates during VR betas highlight their incredible agility, enabling 50% faster market responses compared to industry averages. This ability to iterate and deploy quickly is a massive competitive advantage.
These accumulated advantages are highly sustainable, rooted in compounding data and continuous AI investments. This robust foundation positions them for continued dominance through 2030 as digital engagements continue to grow and diversify.
So the moat looks pretty solid for the medium term.
Their unwavering commitment to continuous research and development, allocating a substantial 15% of their revenue to it, ensures longevity and resilience against future technological leaps.
15% of revenue back into R&D is significant.
However, it's always important to acknowledge potential erosion risks. Things like rapid AI commoditization by tech giants, where sophisticated AI tools become widely available and cheap.
If everyone has great AI, their edge diminishes.
Or stringent regulatory bans on data use could potentially have their moats if metaverse platforms move towards aggressively ad-free models. New entrants with truly disruptive technologies like quantum ad tech could also pose a threat down the line.
Gotta watch out for the unknown unknowns.
But given the company's demonstrated agility in mitigating these risks and its proactive approach to privacy, the probability of significant erosion over the next 5 years is relatively low, estimated at around 20%.
Let's turn our attention now to the company's trajectory and resilience, truly quantifying the significant opportunity ahead for investors.
Okay, the growth story.
Their growth strategy is crystal clear and multifaceted, demonstrating a comprehensive plan for expansion. It involves market penetration, expanding AXON's reach within existing mobile games and apps, market development, tapping into entirely new areas like connected TV and e-commerce advertising,
Growing deeper and wider.
and aggressive product innovation, specifically leveraging AI for new VR ad formats. The actual drivers for this growth include AI enhancements, boosting ad efficacy by 25%, and strategic acquisitions like Adjust in the past, which demonstrably fueled a 40% revenue growth in key segments.
The growth potential here truly is immense, spanning across emerging digital frontiers. Opportunities abound, including aggressive entry into metaverse advertising through strategic partnerships with platform developers.
Partnering with metaverse builders?
Launching entirely new AI products specifically for augmented reality games, and further strategic mergers and acquisitions in the CTV space.
M&A could accelerate things.
While, like any growth story, risks like integration failures exist, past successes, such as the Whirl acquisition, which led to an impressive 20% CTV growth, offer a compelling parallel for future success.
They have a track record of successful M&A integration.
The potential reward here is incredibly significant, capturing a slice of the projected $50 billion immersive ad market that's just beginning to take shape.
And when we talk about total addressable market, or TAM, it's not just growing, it's exploding.
How big are we talking?
The mobile gaming TAM is projected to hit a staggering $126 billion in 2025, with advertising making up approximately $50 billion of that.
$50 billion just in mobile game ads.
This entire digital ad landscape is then projected to grow to an incredible $200 billion by 2030, largely driven by the accelerating adoption of AI and immersive VR technologies.
$200 billion market by 2030.
This company is strategically positioned to grab over 20% of that rapidly expanding market share through AXON's expansion into lucrative segments like hybrid casual games and the metaverse itself.
Aiming for a fifth of that huge market.
Their products apply broadly across gaming, e-commerce, and connected TV, enabling remarkable scalability. For instance, AXON's underlying technology can even be applied in VR education apps, reaching far beyond just niche gaming and demonstrating vast untapped potential.
In terms of operations, their supply chain is diverse and primarily cloud-based, which significantly reduces reliance on any single vendor and mitigates risks like regional outages or geopolitical disruptions.
Cloud gives them flexibility and resilience.
Their customer base is also highly diversified, spanning geographies, with 50% of revenue coming from non-U.S. sources and industries, with gaming currently at 70%, but e-commerce rapidly rising.
So not overly reliant on one country or industry.
This broad base, encompassing over 1 million developers, provides significant stability and reduces dependence on any single client. Looking at longevity, their products are highly likely to be needed far into the future, with an estimated 80% probability.
Ads aren't going away.
As advertising is an enduring, fundamental element of digital realms. They are notably resilient to economic downturns due to their substantial recurring revenue streams.
Recurring revenue provides stability.
Secular trends like AI personalization further ensure their continued relevance, with the company consistently capitalizing through timely AXON upgrades. The key drivers of their growth are clearly AI adoption, CTV expansion, and e-commerce ads, collectively driving over 40% growth.
Those are the main engines.
Of course, main risks to growth include potential saturation in traditional mobile advertising, intense competition from tech giants like Meta and Google, and evolving regulatory privacy changes that could impact data access.
Now, a quick look at macroeconomic factors, which are always a concern for investors. Rising interest rates in 2025 certainly increased borrowing costs for the company's debt.
Makes debt more expensive.
But their robust financial health, particularly strong cash flows, with $832 million in operating cash in Q1, buffer these impacts, allowing them to continue making crucial AI investments without strain.
Strong cash flow helps weather higher rates.
Global trade tensions minimally affect their supply chains, as digital operations largely evade tariffs and physical import-export restrictions. In fact, these tensions can even aid market expansion into Asia amidst shifting global dynamics.
Less exposed to trade wars than physical goods companies.
Inflation does squeeze margins slightly due to rising talent costs, particularly for highly skilled AI engineers, but their inherent pricing power in advertising helps maintain demand, with Q1 margins holding strong at that impressive 40%.
Pricing power helps offset inflation.
From a company-specific angle, AI chip shortages have had minimal impact since they primarily utilize scalable, cloud-based services rather than direct hardware procurement.
Not directly buying tons of GPUs themselves.
And while currency fluctuations do affect international revenue with about 30% exposure, they proactively hedge against this through financial contracts, minimizing risk.
Managing currency risk.
Okay.
Now for the numbers. Let's dive into their robust financial health and truly impressive outperformance, which speaks volumes about their operational excellence.
Let's see the figures.
Their revenue growth has exploded, increasing an astonishing 40% year over year to $1.5 billion in Q1 2025.
40% top-line growth is fantastic at that scale.
This tells a powerful story of AI triumphing over market headwinds, almost like an underdog boxer landing knockout punches in the digital ad arena, consistently taking market share.
Nice analogy.
Their profit margins are equally impressive, with gross margins around 70% and net margins around 40%.
70% gross, 40% net. Very profitable.
This reflects incredibly efficient cost management as they scale their AI platforms, essentially turning every ad dollar into substantial investor value through highly optimized operations.
And for those of you tracking growth and profitability, their rule of 40% is an exceptional 80%. That's 40% growth plus 40% margins.
80% on the rule of 40 is top tier.
To put that in perspective, anything over 40% is generally considered excellent for a software company, signaling they're achieving high growth and high profitability, simultaneously a true unicorn metric in this space.
Best of both worlds.
Their return on invested capital, or ROIC, is around 25%, showcasing savvy capital use in their AI tools, consistently outperforming peers by allocating effectively to high return on investment metaverse pilot projects.
25% ROIC shows good capital allocation.
Looking at their cash and debt position, they're in a very strong place. A current ratio of 2.5 times and debt to equity of 0.4 times, with over $1 billion in cash hoard.
Solid balance sheet, lots of cash.
Providing a substantial safety net for any digital disruptions or strategic acquisitions.
Book value growth is also very healthy, up 30% year over year, steadily building long-term value for shareholders, much like compounding interest in a bull market.
Building equity value consistently?
Free cash flow growth has surged an incredible 50% to $826 million in Q1, offering tremendous flexibility for buybacks, further AI bets, or strategic expansions. It's truly a cash machine humming along even in uncertain times.
Generating a ton of free cash.
Their adjusted EBITDA was over $700 million in Q1, with software platform revenue making up 80% of their total, highlighting a pure-play ad tech focus post-divestiture.
Mostly high-margin software revenue now.
When compared to peers like Unity, which saw only 20% growth, or Meta with flat ad revenues in their core business, this company truly outpaces them, boasting higher margins of 40% compared to an industry average of 30%.
Outperforming direct competitors significantly.
This underscores their significant AI edge and operational efficiency. Furthermore, these key metrics have shown a consistent upward trend over the past 3 years, with revenue projecting from $2 billion to a remarkable $6 billion in 2025.
Projecting to triple revenue in just a few years.
Implying sustained momentum if their digital adaptations continue to succeed.
Now let's explore current investor sentiment and valuation. What it means for you as an individual investor considering this opportunity.
Okay, what's the market thinking and what's it worth?
The current narrative around the company, gleaned from social media and investor forums as of July 2025, indicates predominantly bullish sentiment with about 70% positive.
70% positive is pretty strong sentiment.
Investors are widely praising their AI-driven growth and viewing the recent gaming studio divestiture as a genius pivot that successfully future-proofs the company against metaverse shifts.
People like that divestiture move.
Of course, there are always concerns regarding valuation bubbles, with some questioning a 60 times earnings multiple as potentially overhyped or too rich.
Yeah, a 60 PE will always raise some eyebrows.
Key investor priorities revolve around AI scalability and how quickly they can penetrate new markets, but there are also underlying fears of ad fatigue in new engagement formats, particularly within highly immersive environments.
Will users tolerate ads in the metaverse? That's a key question.
The dominant narrative, however, remains one of innovation leadership, with posts celebrating their impressive 700% stock rise as a clear AI winner in the ad tech space.
Understanding the current stock price is crucial to contextualize this sentiment. As of July 23, 2025, the company is trading at approximately $350 per share.
Okay, $350 a share currently.
This reflects a volatile yet significantly upward trajectory in recent months, having climbed from lows around $200 earlier in the year amid broader market enthusiasm for AI-driven tech stocks.
Big run up this year, then.
In the context of our big question navigating the future of mobile game advertising amid AI, VR, and metaverse disruptions, this price encapsulates investor bets on their ability to pivot their AXON platform towards these new immersive ad formats.
The price reflects high expectations for that pivot.
However, it also implicitly embeds risks if traditional mobile ads falter more rapidly than expected in a world of increasingly fragmented digital engagement. It's a price that assumes continued strong execution.
This brings us to the foundational importance of Benjamin Graham's principle, the margin of safety.
Buying with a buffer, just in case.
It's about buying a stock at a significant discount to its intrinsic value to protect against uncertainties, errors in judgment, or unforeseen market downturns.
It's a classic value investing principle.
For individual investors eyeing this company, this means aiming for a 20–50% buffer below what the company is truly worth, accounting for variables like the pace of AI adoption rates, the maturation of the VR market, or potential competitive shifts.
How much of a discount depends on your risk tolerance?
In today's landscape, where mobile ads could shift dramatically to metaverse integrations, projected to add $5,100 billion in new total addressable market by 2030, a strong margin of safety cushions against scenarios where their adaptations might lag, or market adoption isn't as rapid as anticipated.
Protects your downside if things don't go perfectly.
It ensures that even if growth slows to 15% annually instead of the projected 21%, your investment remains resilient. Without it, you're essentially gambling on perfect execution in an incredibly dynamic digital evolution.
Valuation isn't just about crunching numbers. It's truly your compass, guiding whether you're boarding a rocket ship or a sinking ship, especially for high-growth stocks in a rapidly transforming sector.
Tells you if the price is reasonable or not.
It reveals if the stock is overvalued, like the 20% drop in February 2025 after earnings misses due to unexpected ad volatility, or if it's undervalued and a potential bargain amid AI hype, or simply fairly priced.
Helps avoid buying at the peak of hope.
For management, valuation informs critical capital allocation decisions, such as the strategic $800 million studio divestiture in early 2025, precisely to fund AI R&D and focus on the core ad tech business.
Using valuation to guide strategy.
For investors, it quantifies the risk-reward. At current levels, does the price bake in flawless scaling to VR ads, or does it leave ample room for significant upside if metaverse engagements explode?
What's already priced in?
In a world where AI could boost ad efficiencies tenfold, but privacy regulations erode data moats, proper valuation prevents overpaying for hype, enabling informed decisions that compound wealth over time.
And to value a company like this operating at the cutting edge of high-growth tech, you need a multifaceted approach.
No single magic number.
It requires blending traditional and advanced methods to truly capture its unique tech-centric profile amidst these rapid digital engagement shifts. Intrinsic methods like a discounted cash flow or DCF model, project future free cash flows.
Estimating future cash generation.
Essentially estimating the value of all the cash the company is expected to generate in the future brought back to today's dollars. Based on analyst consensus of a robust 21% revenue growth to $4.5 billion in 2025, with strong 40% margins and factoring in a 12% discount rate.
Standard DCF inputs.
To account for the risks inherent in AI-driven innovation, this method typically yields an intrinsic value around $500 per share.
So DCF suggests $500 significantly above the current $350.
That's what those models suggest, yeah.
We also look at relative multiples, comparing its valuation metrics against similar companies or industry benchmarks. We assess price to earnings or PE ratios and enterprise value to EBITDA or EBITDA,
comparing it to its peers.
This company's trailing PE of 63.29 and forward PE of 58.48, while appearing high when compared to some traditional businesses, actually align quite well with other high-growth AI leaders in the market.
High PE, but maybe justified by growth and AI leadership,
reflecting investor confidence in its future earnings power. The EBITDA at 46.07 also suggests a premium pricing, which is justified by its robust 47% EBITDA margins.
The multiples are high, but perhaps reasonable in context.
Beyond these, advanced methods such as AI-adjusted multiples incorporate the proprietary technology value like AXON's data flywheel, potentially adding a 20–30% premium to its valuation due to its unique capabilities.
Trying to quantify the value of the tech itself?
Or we can use scenario analysis for Metaverse growth, where a bullish case of 30% total addressable market capture and the projected $105 billion mobile gaming ads by 2025 could lift valuation by 50%, while a bear case of VR fragmentation could have growth.
Looking at best and worst case scenarios.
For this company, a hybrid DCF relative approach works best. Stress tested against industry parallels, avoiding over-reliance on static metrics in such a dynamic AI and VR landscape.
Now let's explore the competing theses, giving both the bear and bull arguments a fair, even-handed hearing before we land on the most probable outlook for this company.
Okay, the bull versus bear cage match.
To really understand the bear thesis from an institutional perspective, critics argue that the company's meteoric rise, up 750% in the prior year to around $350 a share, relies on what they call low-quality revenue growth.
Bears are skeptical of that huge run-up.
They suggest this growth is inflated by aggressive AI pushes that might boost short-term metrics but mask underlying vulnerabilities. They point to premium valuations with a PE of 63 times and EBITDA of 46 times.
The high valuation is central to the bear case. No room for error.
Arguing these multiples leave no room for error or unexpected setbacks. If mobile ad saturation truly hits amidst the accelerating shift to VR and the metaverse, where users might increasingly prefer ad-free immersive worlds.
If users reject ads in VR,
revenue could stagnate at a much slower 10–15% growth instead of the projected 21%. This slowdown, they argue, could severely erode margins below 35% as R&D costs balloon for unproven VR integrations and new ad formats.
Slowing growth and shrinking margins is the fear.
Furthermore, bears point to potential regulatory headwinds, such as evolving privacy laws or even outright data bans, which could cripple AXON's data edge, its core competitive advantage.
Regulatory risk is always there, especially concerning data.
They also highlight fierce competition from tech giants like Meta with its metaverse dominance or Google with its vast AI advertising capabilities, which could easily squeeze market share to below 15%.
Can they really compete with Meta and Google long-term?
Retail sentiments on social media echo this cautious outlook, with posts expressing fears of extreme volatility and a bubble waiting to pop if VR truly disrupts traditional mobile ads more severely than expected.
Retail investors getting nervous about a potential bubble.
Bears might forecast a potential 30–50% downside, pushing the stock back to $200–250, especially if Q3 2025 earnings miss expectations due to ad fatigue or slower than anticipated VR ad adoption.
Significant downside potential if things go wrong,
painting the company as a high-risk bet in a highly transitioning digital ecosystem.
Conversely, let's build a robust bull thesis. Institutions viewing this company as a high-growth juggernaut in a multi-trillion-dollar ad market see AXON's AI poised for absolute dominance in these evolving digital engagements.
Bulls see massive potential.
Bulls highlight their exceptional Q1 2025 performance, including a stunning 71% ad growth, $1.5 billion in revenue, and impressive 47% EBITDA margins, all demonstrably driven by innovative generative AI tools that adapt seamlessly to VR and augmented reality.
All numbers look great right now.
They confidently project a 21% or greater revenue compound annual growth rate through 2027 as the mobile gaming total addressable market hits over $105 billion.
Strong growth projected for years to come.
Critically, economies of scale and powerful network effects amplify this growth. More data from over 1 billion daily impressions refines targeting tenfold, capturing a projected $50 billion new opportunity in Metaverse ad spend, a market that's just beginning to open up.
The moat and scale will drive future growth. Confidence among bulls is significantly bolstered by the company's proven track record of successful strategic pivots, like its resilience and continued growth post-Apple's IDFA changes, a period where many competitors struggled.
They've navigated tough transitions before.
Discounted cash flow models from leading analysts frequently peg their fair value significantly higher than current prices, ranging from $500 to $650 per share.
Analyst price targets are much higher, $500, $650.
Retail investors on social media are equally exuberant, celebrating the genius divestiture of the gaming studios and the company's clear rise as an AI ad king.
Retail bulls are very enthusiastic.
They emphasize the strong founder-led alignment and the company's substantial $1 billion cash hoard, which provides tremendous flexibility for potential mergers and acquisitions to accelerate their market penetration.
Leadership and financial strength are key bull points.
Bulls forecast significant upside, potentially 50-100% to $500-700, if immersive ads truly take off and their AXON platform becomes the dominant monetization layer.
Potential for the stock to double if the Metaverse bet pays off.
This positions the company for continued strong performance as a dominant force in tomorrow's digital world.
So what's the most probable outcome, given these compelling yet conflicting viewpoints?
Our thesis leans strongly bullish, supported by a consistent track record of execution, undeniable AI tailwinds, and a clear consensus among analysts, which has an average target price implying around 32% upside from the current trading levels.
So leaning towards the bull case based on execution and trends?
Yeah. While the bear case raises valid valuation concerns and highlights potential risks, the company's strong data moat, its proprietary AI, and its proven execution speed align perfectly with the powerful secular trends we're seeing, particularly generative AI and VR integration.
The strengths seem to outweigh the risks, in your view.
These factors, in our view, significantly outweigh the risks in a market that continues to favor growth and innovation.
Based on the current price of around $350 and our robust bullish thesis, the company appears to be trading at a meaningful discount to its estimated intrinsic value, which we calculated to be around $450-500 per share via a hybrid discounted cash flow and relative valuation methods.
So, currently undervalued based on your analysis.
That's what our work suggests. This offers a compelling margin of safety of 25-40%, a protective buffer for investors.
A decent margin of safety at current prices.
This undervaluation likely stems from some residual market skepticism on near-term volatility or the pace of VR adoption, but all available data, including strong Q1 earnings beats, a clear and ambitious AI roadmap, and a massive, expanding $105 billion total addressable market.
The fundamentals look strong.
Supports significant upside if its adaptations to VR and the Metaverse succeed. This makes it a truly compelling opportunity for patient investors who are betting on the continued evolution of digital engagement and the companies that power it.
So let's revisit our big question. What happens to the multi-billion-dollar engine of mobile game advertising in the face of rapid digital transformation?
The verdict.
The answer, unequivocally, is that it is undergoing a profound metamorphosis. Driven by rapid advances in digital engagement, AI is enabling hyper-personalized generative ads that can predict user desires before they even click.
AI is changing the game completely.
VR and AR are creating immersive worlds where ads manifest as interactive native elements like branded virtual gear within games or dynamic billboards that feel like part of the environment.
Ads becoming part of the virtual world itself.
And metaverses are fostering persistent social realities that seamlessly blend gaming with e-commerce, potentially shifting $50-100 billion in ad spend from interruptive banners to seamless integrations by 2030.
Huge amounts of ad spend are potentially shifting.
Industry reports project mobile gaming revenue hitting over $105 billion. But with trends like AI and ad buying boosting efficiencies by 30-50%, and VR adoption expected to see 40% user growth via new devices, traditional formats may decline as users increasingly demand non-disruptive integrated experiences.
Can the company's products adapt and scale to this new reality? Absolutely, and with high conviction. Its AI-centric suite is tailor-made for this shift.
They're built for this future.
AXON 2.0, which processes an astonishing 200 billion daily requests, is already generating adaptive creatives that embed seamlessly in VR prototypes, as piloted in Q1 2025 partnerships, yielding impressive 35% return on investment lifts.
Already showing success in VR pilots.
The 2025 roadmap includes AXON 3.0, specifically designed for Metaverse data fusion, merging mobile insights with VR behaviors for a tenfold increase in targeting precision.
AXON 3.0 is the next big step.
Post-divestiture, the company's pure-play focus on ad tech enables unparalleled scalability. Network effects from over 1 million developers amplify as VR games join the ecosystem, with CTV expansions capturing hybrid engagements across different screens.
The focus helps them scale faster.
Quantitative proof includes that stellar 71% ad growth in Q1 amidst the broader AI hype, outpacing peers significantly. The leadership's strategic pivot from games to ads mirrors past successes, like expertly navigating the IDFA changes with 50% revenue jumps.
History suggests they can manage these transitions.
While risks exist, such as the potential emergence of metaverse monopolies by other tech giants, the company's agility, proprietary technology, and strong cash position enable it to acquire crucial VR tech or form strategic partnerships to maintain its lead.
They have the resources to stay competitive.
In our opinion, this company not only adapts, but clearly leads this transformation, driven by its data moat and execution speed, which align perfectly with secular trends like generative AI and the participatory shift in AR advertising, potentially tripling its market share in immersive ads.
Now, for a final provocative thought for your consideration as an investor navigating this rapidly evolving landscape, thinking from first principles, strip away the hype and consider the immutable truths.
Get back to basics.
Digital engagement consistently evolves toward greater immersion, from text to video to virtual reality. And advertising, just as consistently, follows users, ultimately rewarding platforms that personalize without intrusion.
Advertising follows eyeballs, and eyeballs want immersion.
Asymmetric information offers a unique edge for outperformance in markets. Consider that this company's under-the-radar VR beta tests are showing significant engagement uplifts, signaling untapped potential not yet fully priced into the market.
Information the broader market might not appreciate yet.
Furthermore, for treasuries and technology companies, consider a unique strategy of holding Bitcoin to hedge against inflation and enhance balance sheet resilience, mirroring growth volatility.
Interesting thought, tech companies using Bitcoin on their balance sheet.
This company, for instance, could potentially hedge inflation with even a small allocation, providing an edge in volatile ad cycles. Be mindful of known unknowns. Regulatory curveballs like potential AI data bans that could have targeting efficacy.
Things we know we don't know, like future regulation.
Or sudden leaps in competitor quantum ad technology that could fundamentally alter the ad ecosystem. And prepare for unknown unknowns, those true black swan events, such as a metaverse winter if VR hardware adoption stalls unexpectedly.
Or something completely unforeseen.
Or an unforeseen, widespread AI ethics backlash leading to massive boycotts of personalized ads. For your investor edge, track niche metrics like developer VR integration rates via the company's API dashboards. If they exceed 30% by Q3 2025, that could signal a strong buy.
Keep an eye on those specific adoption metrics.
And continue to monitor social media for real-time sentiment shifts to gauge hype versus reality.
Love this? Drop a like, subscribe, and ring a bell so you never miss a podcast.